BMO just dropped a bomb. It's scary how similar Canada's housing market is to the US crash in 2007. The data confirms we are on the same path, tracking alongside the most devastating housing market collapse in modern history. So I'm going to be breaking down the one key chart BMO released and what you need to know as a Canadian homeowner or buyer in this market. Let's get into it. Hi, my name is Zen, and if you enjoy my data-driven and number-crunching real estate updates, be sure to like and subscribe. The Canadian real estate resembles US bubble, so this is talking about the great financial crisis of 2008, after a perfect storm. And there's been a lot of conversations about where we are in this bubble, quote unquote, or where we are in this crash or this downturn or this cycle, whatever word you want to use. Prices are coming down, and it looks like it's going to continue in that direction for quite some time. There's this quote that always says, history doesn't repeat, but it sure does rhyme. And a lot of people are trying to see what similarities we can draw upon, call it the 2008 crash, or maybe even the 1990 crash, where we can see where are we in our current cycle from the peak price in 2022 and how long it's going to take to recover. But there's three things I'm basically looking for, which I'll get to at the end of the video. But I want to kind of go through what the current cycles have looked like for the 2008 US crash and Ontario 1990s so that you get an idea of what's going on. So there's actually a really great chart from BMO over here that outlines kind of how long it takes to recover from the peak of the price. So this is the chart from BMO, and I'm going to show you how to basically read this because it's a little bit complicated. So on the y-axis over here, you have effectively what you would call a percentage. And the peak pricing would have been at 100% of the actual price. So in our instance, which is the dark blue line over here, which is the Ontario current, your peak price would have been in February 2022 for like $1.3 million. Now, when we compare ourselves to, say, the Ontario 1990s light blue line, which is this light blue line here, the peak would be also right over here. And when we do the same thing for the 2008 or 2007, in this case, US financial crisis, it would be over here too. Now, how you measure the amount of years to recover is basically you draw a straight line right across, and at what point is it hit that same 100% mark. And you can see over here, somewhere in the US, it took about 10 years, and in Ontario, it took a little bit more than 11 years. And that's kind of what this chart is symbolizing. So let's look at Ontario, how they fared. So when they peaked, it peaked in 1989 from my research, and the bottom technically would have been right here. Now, in this chart, it says it's down about 19%, and I extrapolated data over here. However, depending on what data you use and what metric, it skews somewhere between 20 to 40%. And that's mainly because some people use averages, some people use nominal, which is like the actual dollar amount. Some people use inflation adjusted. But to keep things all consistent, I'm just using nominal as the same thing as what BMO is using right here. So for the Ontario 1990s crash, it bottomed in 1996, and it fell down 19%. Now here's the kicker. It took 7 years from the peak pricing over here to get to the bottom. Now, in Ontario 1990s, it took 11 years to recover. Basically, it took to the year 2000 to get back to the peak pricing on a nominal basis, meaning if the dollars are worth the same thing right now, it took 11 years from the peak to recovery of the exact same price. So that's why a lot of people say that the 1990s was a lost decade for real estate because your prices didn't really go anywhere. Now, I am going to preface this one thing for anyone who is looking to buy or sell right now. If you're buying and selling in the same market, you're buying in the same market. Now, what do I mean about that? If you're buying and selling in the same market, it means that you're going to have all the benefits of buying in a down market when prices are down, but at the same time, you have a hard time selling. Meaning that when you're trading real estate, buying and selling, it's going to be that exact same finite window, plus or minus 3 months for your closing and when you go list your property. This is why people who are upgrading or downsizing, you're trading in the exact same market. So timing the market doesn't really do too much. There are differences at the margin where like the more expensive property comes down more in a down market by like, few $10,000, but then you also set yourself up for selling your property could be harder. So when we get into those nuances, it's not so much a macro picture, it's more so a micro picture and the local markets that you're trying to buy and sell in that you should be focusing on. Hey, it's me interrupting myself. Ready to make a move? Just one free call. No hassle, but decades of experience to work for you. Now here's the US to see how well it rhymes. In 2007, it peaked at 100 and it bottomed in February 2012 because the US data is a little bit better. I could pinpoint it down to the month and it went down 27%, and it took 5 years to bottom. Now, for the US, it took 10 years to recover, and it recovered back in 2015. So you can see in the US, it dropped faster and it increased back faster. So because the volatility was that much higher, meaning it dropped faster and increased higher, it took a shorter duration to recover. Now that you understand the rhyming component of this in US and in Ontario, let's compare it to how we fare right now. If you're looking at this chart right here, you can see if we just look at this line right here, based on the duration right here, it has actually dropped the most in the shortest amount of time. And if you're wondering what on earth is this little hump over here where prices went up, looks like 5 to 6%, that's when Silicon Valley Bank collapsed and fixed rates went to 4% when your variable is at 6. So that 2% interest rate spread, or 200 bips, made enough of a difference where prices did jump back up. But then shortly after, right over here, the Bank of Canada hiked rates again, and it kind of made the market fall. And that's why we've been dealing with a downward market for the last, call it, 3.5 years. So this is where we are in a snapshot right now. Currently, with the latest numbers that I have, September 2025, your average price is $1,050,000. It's down 26% so far from the peak, and we are 3.5 years into our cycle, our bear market, whatever you want to call it, our crash. It's totally up to you. Our peak was February 2022, and the average price was 1.3 million. Again, this is as a whole aggregate for everything. Now, if I relay what happened in, say, the US, where it took 10 years to recover, it would take us to 2032 before we hit $1.3 million again as average price. If I use the Ontario one, which kind of chopped a little bit more sideways, so you can see over here, it was not as volatile, but it kind of chopped up and down, up and down. It took 11 years to recover, which is over here. If I make that rhyme in our current situation, it would take to 2033 for 11 years to recover. But here's kind of the tricky thing. If you are trying to buy right now and call it time the bottom, which again, I don't think it's a great idea, but you can always try. We don't know if the bottom is here, if it's here, if it's here, or if it's here. We don't, because the recovery is not going to be a straight line. It's not going to be any of these straight lines. For all we know, let's say we have to magically get to this here. We could go like this. 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 There's many ways to get there, and we won't know. And this is why I always have 3 metrics that I look out for to kind of get an idea of where things are going to go. In the short term, it's inventory. And when I mean short term, I'm talking like 30 to 90 days. In the medium term, it's interest rate, generally somewhere between 1 year to 18 months, because that's how long it takes for interest rates to take effect on the market. And then the third one would be 3 years plus, which is your macroeconomic trends, call it like your recessions or like geopolitical wars and stuff like that. So when I talk about these things I look out for on to dictate whether prices are coming down, the first one that comes up is inventory. This is a chart I showed in my previous video talking about months of inventory, which is effectively just a ratio of how many unsold properties there are at the top divided by how many sold properties there are. So the higher the number, it means the weaker the market. Or in layman's term, if you want to think about it, if I have a month of inventory of 5, I do 1 month divided by 5, it means that there is a 20% chance of your property selling. When the market was hot, it was 2 months of inventory, 1 divided by 2, that puts you at a 50% chance of selling. So that's kind of basically what it means. And you can see over here, for the 30 to 90 day forecast of where prices are going to go, it's very obvious it's going to go down because we have the most amount of inventory that we have ever seen in September. This is at 5.25. It's very, very high. If you ask me where prices are going to next 30 to 90 days, it's going to trend down. So when someone asks me, hey, have we hit the bottom yet right now? No, we have not. I think there's more bottom to hit, at least in the next 90 days. And finally, on a macro picture, what I will always look for is recession. Is the economy going to go down into the gutters? So the highlighted yellow box over here is the 1990s Ontario crash. And you can see over here, unemployment rate got as high as 11%. And it trickled down afterwards in the 2000s, and then prices started rebounding. So that is a correlation right now. And during our current downtrend in prices right now, Ontario is right here in this yellow line. You can see unemployment is hiking. With the latest print right now, where Ontario is at 7.2, and Toronto is at 8.9. And the last time I showed this, Toronto was at actually 9.2, and it's actually down by 3.2%. So it's trending the right way and may not hit recession. But again, we don't know because a lot of the times, same thing with bubbles and recessions, we only find out afterwards looking back. So let me summarize for you, because depending on which time horizon someone is trying to talk to you about and when prices are going to rebound, they differ. So on a short term, looking at months of inventory, it's very obvious in the next 30 to 90 days, there's going to be pricing pressure coming down. And on the long-term horizon, how bad is the economy? And I'm going to look at the unemployment rate right now. If we basically hover around 7, things may not look that dire. But if we start spiking and maybe we see AI kind of ruin unemployment, it's a whole different story. And these are things that it's hard to predict. So depending on your time horizon, you have to look at the proper metric. And this is why it's so obvious for me when I do the Market Watch update that I know where prices are generally going to go in the next 3 months, because I look at the inventory. And if you want a deeper dive on the latest data that talks about how our inventory is right now and why prices should continue for the balance of 2025, make sure you click on the video that's on screen right here. I'll see you in that video. Until next time, your move, your future. See ya.